Hello, chart watchers, and welcome to this Thursday, June 20th, 2019 Market Watchers live show with your host, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Today, we see the market higher today, although we are off our earlier highs. Currently, the Dow Jones Industrial Average up 174 points. The S&P 500 up just under 19. The NASDAQ up 52, but was up much higher earlier today. The Russell 2000 also off of its earlier highs, currently up about 7 points. 10-year Treasury yield continues falling today beneath 2%, down 4.5 basis points back to 1.98%. That is big news in a number of areas of the market. We'll talk about that throughout the show. Volatility index, after being much lower earlier today, you can see down at probably about a 6-week low. We have reversed off those earlier lows, and the VIX is now up about 3%. Energy, big move to the upside. Oil prices shooting higher. Seeing a lot of energy shares rising as well. Technology also having a good day, breaking out of this cup off of an uptrend, but still going to need to negotiate that early May high. Industrials also continuing their breakout that they enjoyed earlier this week. Real estate following through to the upside. Financials lagging, which makes perfect sense given the falling Treasury yields. Financials do tend to underperform when yields are falling. You can see one of the areas of energy here, the oil equipment and services group, rising strongly with the higher crude oil prices. But we do have overhead price resistance near 250. We'll see if we can get through that. Consumer finance also trying to make a breakout today, and this despite the weakness that we saw in financials. This is one of the areas of financials that have been performing extremely well. You can see the double top breakout that occurred earlier in June. We pulled back, held rising moving averages, and now trying to make another breakout. Oracle, in somewhat of a surprise, big earnings report, beat on the top line, beat on the bottom line. And when you've got one of the worst relative performers in the software group coming up with that kind of report, it is certainly lifting the whole group. Software doing well today. And then finally, one of the reasons, one of the things we wanted to talk about today, and we're going to talk about later in the show, is gold. And the reason, with the Fed turning more dovish and with these Treasury yields moving lower, it tends to weaken the dollar. And as a result, gold becomes an investment of choice. You can see a huge move there in gold. We are at a 6-year high on gold. So that's going to be, again, a topic of discussion later in the show. Erin, I know you've been really bullish on gold of late. And even in a surprise move, I've been somewhat bullish with gold as well. But what do you think? Do you think this move continues for a bit?
I do. Actually, I was a little surprised. I wrote about gold yesterday in my DP alert. And, I was bullish. I expected the breakout, but I was expecting that gold would have a little more trouble with that overhead resistance at that multi-year high. I thought we might have to wait a little bit before we'd get that punch right through. But wow, it just knife through butter, hot butter, I think. Hot
Yeah.
knife through
Hot
butter.
knife. Yeah, it definitely gold mining shares is the hot knife because it's going right through a number of areas of resistance. That whole space definitely been strong. But we will talk later about gold in the show, and we'll be doing so with Julius de Kempenaer, who is joining us today. Special guest. Always have fun when you're on the show. Julius, welcome back.
Thank you, Tom. Nice to be here. Nice to be back. Hi, Erin.
Hello.
Yeah, it's what do you make? We're going to get on with the show here in just a second, but looking at what the Fed did yesterday, we've got central bankers around the world that have been pretty dovish, but the U.S., we've seen, a little different stance from our federal or central bankers. But yesterday, they kind of switched a little bit as the market was expecting. And now the Fed funds futures are pointing to basically 100% chance that we are going to see a quarter-point drop in the Fed funds rate next month. I mean, what do you make of what the Fed's doing here, and how does that impact how you're looking at the market?
That's the short end of the curve. It's directed by, it's not by market forces. I pay attention because it has an impact, and a lot of people react to it. But my experience is, my experience is that this type of news, because it's news, impacts the market when the news comes out. but very rapidly after that, like we're talking days, the market continues to do what it's been doing and, almost forgot about what it is. And then we go back to the big picture, which is that from a European point of view, interest rates in the US are still super, super high. Because I think you said it's like 2% now, or 1.99.
Yes.
1.98. So that basically means, and listen carefully, you got about 2.3% downside potential.
Yeah. I know that, when we look at the 10-year Treasury yield in the U.S. versus foreign markets, of course, the U.S. rates have been going up a lot higher, but that seems to have changed here over the course of the last, I don't know, I'd say probably last 9 months or so. And we're starting to see the U.S. Treasury yields dropping more rapidly than we're seeing in other parts of the world. And that obviously does have a lot of impacts. We'll talk about some of that later in the show. But why don't we go ahead and jump in, Erin, and get things rolling here. We got a lot to do here with Julius today.
Indeed. Next week, we'll be doing a roundtable on pop culture stocks. So you'll want to go watch that. Brian Shannon will be with us on Wednesday. We'll be bringing Dan Russo back from Chaikin Analytics on Thursday. And happy 4th of July. Can you believe it? July 4th is almost here. We will not have a Market Watchers show because the market will be closed. All right, we will start off with a roundtable about our market analysis versus portfolio construction after our technical news and headlines. Planet Fitness is our first symbol, PLNT and 10 and 10. Then we have a special Talking Technically. And Are You Buying This is the segment where we will concentrate on gold discussions. All right, Tom, technical news and headlines.
All right, well, we're going to start with economic reports. Of course, it is Thursday. So initial jobless claims came out this morning. They were actually a little better than expected, 216,000 versus 220,000. But then June Philadelphia Fed survey came in much lower than expected, 0.3 versus 11. And finally, May leading indicators came in after the market opened at about 10 a.m. Eastern. They were flat. Market was expecting a rise of 0.1%. And all of that, when you put it together, leads to a breakdown, that along with the Fed, of course. You can see the 10-year Treasury yield, which was at 204 support, is actually breaking down below that today. And now we have to go all the way back to November of 2016 to see the last time that we had a 10-year Treasury yield beneath 2%. And unfortunately, one of the things that is impacting are the financial stocks. That's a group that's one of the aggressive areas of the market that have been underperforming throughout much of the recent past. I'm going to say last year and a half. And I don't know that the group as a whole is going to continue to perform or is going to outperform the benchmark until we see a turn in this 10-year Treasury yield back to the upside. So that is definitely having an impact on some areas, but other areas, as you get a lower 10-year Treasury yield, that is a big influencer of mortgage rates, and mortgage rates, as they drop, that's a very good thing for home builders and home construction. So there are some areas of the market that are going to benefit, others will not. As far as earnings go, we did have a couple earnings reports out, as I mentioned at the top of the show. Oracle did come out with its earnings, and Oracle beat. They came in at 116 versus 107. Kroger beat, and then Darden Restaurants also came in with a beat. Unfortunately, a couple of those reports came with guidance to the downside or just inline guidance. Oracle's clearly was the best report there. We also had a company that came in and guided higher last night after the bell. So I'm going to take a look at those charts. So I'm going to start with that last one that guided higher. That would be CACI International. So after the bell, and when you look at this, some of these companies that reported that guided lower, I think it was already telling you on the chart. We talk about this relative strength so often, and I really can't stress enough the importance, at least in my opinion, to following what is working in the market and what is not. The market is telling us, telegraphing what is going on fundamentally in these companies. CACI, if you see it coming across here, equal highs, rising lows off of an uptrend, a beautiful ascending triangle. They came out and they guided their midpoint EPS higher in the next quarter. And you can see stock making a move to the upside. Notice also that over the past, 30 days, maybe 5 weeks or so, The group has been moving higher relative to the S&P 500. Overall, it's just been an okay group for the last year. But I think if you look at this stock versus its peers and versus the S&P 500, it continues to trend higher. That's telling you that Wall Street likes the company. And now today we're getting the fundamental news and reason why. So CACI looks pretty good. Oracle. Now this one, I said going into this report, I didn't like it. They came out anyway with a very, very strong report. They beat on their top line, beat on their bottom line. Stock gapped up above this prior consolidation that we've seen over the past few months. You know, that when you look at the software group, we were trying to move to new highs. Even yesterday, we actually did move to a new all-time high. And you can see Oracle was not really trading very strongly heading into its report. Here is Oracle relative to the software group. Just all of this is, you know, kind of, I don't know, telling me this is a stock I really didn't want to be a part of. But they did come through. I think this could be a character change, maybe not on the absolute chart, but I think on their relative chart. They've been in this relative downtrend. This could begin a move to the upside. I'm just going to quickly annotate this because if you notice, we had some key relative support right around this level. If you go back throughout the last year, and then we broke down, we came back up, we struggled there. Let's see if we can continue this strength on Oracle. I wouldn't be jumping in today. I think there are other software stocks that I trust a lot more. We could see a big reversal before the end of the day. I'd just be a little careful because this company has underperformed now for quite a while. But no doubt about it, the report was solid. So far, we're getting a really good reaction to Oracle's earnings report. Let's take a look at KR, which is Kroger. Now, Kroger reported, and they did miss on their top line. They beat on their bottom line by a penny, and they guided in line. Look at the relative strength, though. Kroger versus its, the food group. You can see not very good leadership, actually no leadership, lack of leadership here. We did gap down again, trying to recover, but I think this stock's got a lot of repairing to do on its chart. I certainly would avoid there. Then we've got DRI, which is Darden Restaurants. And you can see Darden on this pullback here to 114 is holding. But the problem with Darden is that they guided their fiscal year 20 lower. That was the reason we saw the gap down, moving up. But just keep in mind, this has been a very strong group, and Darden has not been a very good performer in the group. So I think we got some issues there. And then the last one I wanted to show you was CCL. This is Carnival Corp. Big move down. Another one that on a relative basis here, really, really struggling to the downside. So not a stock that I would certainly recommend, and I would be waiting maybe for a little action there. Okay, let's move on into the scooter mover of the day. And the scooter mover of the day, I'm going to go with Hesse, H-E-S. It's one of the top movers among large caps. And I think we're at a key point in terms of resistance because we had this volume pickup, the big gap down right there. You can see kind of aligns with some of these other prior highs and lows. And today's high came right up. So it's good to see it improving on a scooter basis, but the stock still has a lot of work here to do. That's my scooter mover of the day.
All right, let's go ahead and move into some upgrades and downgrades. And let's see, make sure we're all where we need to be. It's not sharing, is it? There.
Yeah, I'm not seeing it yet. There you go.
That was strange. Don't usually have that problem. Okay, so let's go ahead and we will look at AES. AES was upgraded today by B of A Merrill, and it was moved from an underperform to a neutral. So we're not looking at a buy signal here as far as this upgrade goes. Let's move that over here. What I wanted to note was, first of all, is the PMO buy signal in oversold territory. So let's see, I want a vertical here. So it came in right about there. That's where our buy signal came in. And you can see it was a little on the late side. And since then, we've seen more of a consolidation zone. I'm going to go with the overhead resistance, obviously in the short term, right around 17, just above 1720. And then I would look at my support right about here. Question is, of course, whether we're going to get that breakout. And clearly, B of A Merrill says we will. And honestly, the PMO is saying we will as well. All righty. I've got a problem here being able to see some stuff. Okay, here we go. Next one up is going to be JW Nordstrom, which I thought was interesting because I know we've been talking about that area of the market really suffering right now, but it looks like Gordon Haskett has changed it from a reduce to a hold. So again, we're looking at a neutral signal here, not anything that exciting, I would say, as far as their upgrade goes. I would mark, first of all, this gap right here. That's what I would expect to be covered. And the reason I say that is because we do have that. Let's get that right here. We do have a PMO buy signal that's marked right in here. It's mainly we got some sideways consolidation, but that signal seems to finally be coming to fruition. So honestly, I would be looking at this to fill that gap. I don't know that I would be overly excited past that, but right now that big volume that came in yesterday, I think was very encouraging here for JW Nordstrom. TE Connectivity. This one was upgraded today from a neutral to a buy. So we're finally looking at one that's on a buy signal. Let's go with another vertical line here, right at where the PMO buy signal came in. And there you go. The buy signal was a little bit late in this case, but notice the PMO really didn't lose much steam, excuse me, on this pullback. It ended up turning into more of a flag formation than anything else. And we got the move to execute that flag right around 93. And now we're getting ready to hit overhead resistance right up here above 96. We're really close to it. I would say given this buy signal, you can see also on balance volume going the right direction. We even had the setup here. Let's see if I can make this a little bigger on the OBV here. There we go. I was going to say it looked like we had a positive divergence here on the OBV. You had all this declining trend, but you could see we were really more flat. Now we're moving up as well in the OBV. So I think that's positive as well. I like it. Next one, we're going to move into the downgrades, and let's start with Enphase Energy. It was downgraded by H.C. Wainwright today from a buy to a neutral, and they have moved their target. There we go. We got our horizontal line. They've moved their target to $16. So that's $16.10. So pretty much back here where we hit some short-term overhead resistance where we formed that. Now we're heading back through. So they're downgrading it to a neutral. That's not the biggest drop I've ever seen. Let's look at the PMO a little more closely. Really flat PMO, mainly because you're seeing acceleration really not increasing and not really decreasing. The acceleration was very steady, and that's going to flatten your PMO. PMO's actually got a buy signal about ready to happen here, because you can see 1277 versus the 1278 on the signal line. You know, I can see this has been a really steep move to the upside. So I can see a downgrade here just because I'd be looking for that pullback. But, you know, honestly, the PMO is telling me that we could move higher on ENPH, Enphase Energy. All right, Hershey is our next one. Piper Jaffray moved it from neutral to underweight. Not a surprise. I suspect you could have looked at this as a flag, but when you see a PMO that's turning over and has now generated a sell signal, and that signal I suspect came in yesterday. Yes, it did. So it was giving us warning that this is more of a rounded top, not a flag formation. So I would expect a move to the downside. The next area I'd say of support would be right here at that short-term top that we had here in mid-May. Next one and last one is NVO, which is Novo Nordisk. And this one was downgraded from a buy to a hold. So they're moving more into a neutral position with this. But I see a short-term double top pretty much lined up there. Let's just mark it right here. There is one part of the top, and then there is the other part of the top. And then our confirmation line would be right here, right across there. So if we get the execution of the double top, then you're going to look at the measurement, and that's going to bring you down. Really, you would cover this gap that we've seen here. So let's mark that gap. So you'll cover the gap, and then more than likely you'd move down a bit further. But that's the minimum downside target would really be right there to cover that gap that we had back there. Okay, that's all I have for upgrades, downgrades. Here is the list of what I went through. We will be right back with our special roundtable after this.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Okay, welcome back. We are going to start a special roundtable discussion, and it all started with an article that Julius de Kempenaer wrote in his blog, his RRG Charts blog, and it was titled Market Analysis and Portfolio Construction Are Two Completely Different Animals in the Same Zoo. And I know, Julius, you had a question from one of your readers that kind of triggered the whole idea about this article. But why don't you just take a couple minutes and explain the question that came up and your process of going through this, and maybe a little bit about the difference between the two, and then we'll get into a lively discussion.
Yeah. Well, the reason that this came up is because, first of all, I like the interaction with readers. I don't like writing articles without knowing that they actually are interesting for people. So I always encourage people to respond or send me an email or communicate in whatever format. And I try to keep my response rate pretty high. Now, previous to this one, I wrote an article on CocaCola and McDonalds. These were stocks that caught my attention in the Dow Jones Industrials. And on that article, the question came from someone asking, would you suggest to own the entire ETF of a leading sector like XLP, individual high-performing stocks within the ETF like KO, or both the XLP stocks within it like KO and KJC? And that came in discuss. So I sat down to respond to that question. But after, I don't know, 15 minutes, I was like halfway through a complete article explaining what I was doing. I thought, you know, this is crazy. Let me just make this into an article. And that's what happened. And the reason why I wanted to make it an article is because I think that it is something that a lot of people not really think about. Everybody does it, you know, in one way or another. If you're investing, you are taking these decisions and thinking about it and acting on it, maybe even unconsciously. And I think this subject deserves a little bit more attention than it might get from us as a group of investors usually. And I had to think about when I was working as a portfolio manager on the buy side at an institution, and I realized when I was writing that answer that analysts and portfolio managers are separate roles. Analysts analyze, they look at the market, they come up with ideas, they present them to the portfolio managers, and then it's basically out of the hands of the analyst. It goes into the hands of the portfolio manager, and he takes a look at the analysis, and he gathers and aggregates analysis, looks at it, makes up his mind, looks at his portfolio, looks at the mandate of his portfolio. What am I doing here? if you're a private investor, it could be your 401k, it could be a speculative portfolio, it can be anything. If you're a professional PM, you might be running an asset allocation fund. You may be running a fund that needs to beat the S&P 500, or you are running a technology fund that needs to beat the technology index, XLK. There's all kinds of different portfolios. So that same piece of research can impact different portfolio managers in a different way. The portfolios can have different restrictions. So it's actually, that triggered me to think it's actually a different thought process. People think about different things. These PMs think about different things to implement that view of the analyst into that portfolio. And that is what I tried to explain, and I tried to give a little bit of guidance and a couple of things that I try to do, also touching upon the various risk parameters that you will get from different implementations. You know, one implementation is a little bit more risky than another one. So that's a little bit of the background of the article and how it came to life and why we were talking about it right now.
All right. Well, Julius, I know you said that you were a portfolio manager.
Yes.
Did you do both roles? I mean, did you also do the role of doing the analysis and then also trying to figure out based on, risks and so forth?
Yeah, I started out as I actually started out as a portfolio manager for a life insurance company. That was a junior role. So at the time I was co-responsible for a portfolio at that time of Dutch stocks. Then I moved to what's called a buy-side analyst role, where I was an analyst for an asset manager, basically advising portfolio managers or providing research to portfolio managers that they could implement. And then I moved to the sell side, where I was a sell side analyst, where I was one of the analysts that was providing research to the street, to the PMs at the various buy-side shops. So I saw like three, but the only thing I never really did was either a buy-side trader or a sell-side trader. That's the guy who actually implements the trade. So on the buy side, on the asset management side, you got the analyst, you got the PM. And then when the PM has made up his mind and he says, I'm going to buy 3 million shares of Microsoft and 2 million shares of Amazon, then that trade goes to the trader, whose responsibility then is to execute that trade in the market, using whatever algorithm or block trades or dark pools or whatever there is. And all these rules are all actually full-time jobs. That's why they're separated and really busy jobs.
All right, well, let's get into the meat of the article. I want to get into that question that you had from the viewer or your reader who asked about, an ETF. If we just talk about, say, consumer staples, the XLP, of course, that is an ETF that holds a basket of stocks, some of which may be performing very well, some of which may not be performing very well. So the question, I think, is pretty interesting. Would you consider buying just individual strong performing stocks within the ETF, or would you buy both? Would you buy the ETF and some additional stocks? And after you answer that question, I'd like to see what Erin has to say about that as well.
Yeah, there are, for me, the answer to that question comes down to the risk appetite of the owner of the portfolio. The very short and simple answer is, if you are risk averse, you don't like to take a little bit of extra risk, then you just buy the ETF, because that gives you exposure to the whole sector in the weightings that sector holds. So you're not hurt by individual stock risk. You can have XLP. If one of the stocks in XLP drops rapidly, then you will not get hurt that bad. I'm sorry. Yeah. If you like a little bit more risk, then you can go to get like 3 or 5 individual stocks and make up your own portfolio. So
would you then do your own allocation, like within the consumer staples? We talked about this a little bit before the show started. The XLP obviously is weighted a certain percentage to a number of stocks. And I know we talked about, you could change that weighting. And we discussed a little bit a spreadsheet that you had kind of put together. I don't know if you can share that, but before, maybe just think about that for a minute. And I'd like to get Erin's thoughts on the idea of, instead of trading an ETF, how about just trading some of the stocks within the ETF. What do you think, Erin?
Well, I think a lot of people don't realize, and I know we've talked about it before, but a lot of these sectors, these ETFs are made up of, the majority of them are like 3 or 4 holdings. I mean, you do get exposure all the way through, but the problem is a lot of times you're already getting stuck into, buying like the top 3, top 4 just by buying that particular sector. One of the things that I consider if I'm going to do, try and spread my risk within a sector is a lot of times I'll just go into an equal weight, because then you're really getting that exposure equally among all of the participants, and you're not kind of stuck with like the top 3, top 4 taking up your entire portfolio. I think that if you're really pro that sector, then that certainly could be good. It might perform a little better. But what we found at Decision Point is that the equal weights tend to perform better moving up, but they do take the hit harder on the way down. So it's just something you have to think about.
And I would just add, my preference when I look at ETFs, I'm not against ETFs. And I honestly think that if someone is not following the market closely, I think you're better off investing for the long term in these various ETFs and just kind of going through and probably doing some sort of a redistribution every once in a while as they kind of get away from you to the up. Some become overweighted in your portfolio, others become underweighted. So I think it's a good idea. But for me, because I'm so active in the market, I actually don't like ETFs. And I'll give you an example. If you look at something like the SMH, which is an ETF that tracks the semiconductors, you have to understand that significant weighting, like you mentioned, Erin, you've got Intel, which has been a laggard. And that is one of the top stocks in that ETF. So when you buy the SMH and you think, oh, semiconductors had a great day today, I'm in the SMH, this is wonderful. Well, sometimes you look and you're like, well, they didn't perform as well as I thought they should have. And the big reason is that you've got stocks that are very heavy weighted within that ETF, and they just don't look good to me on a relative basis. So I don't want to put money into an ETF thinking that I'm doing this wonderful allocation, and at the same time, I'm kind of throwing my money down a rat hole because I'm chasing stocks within the ETF that have been underperformers. But why don't you go ahead and take it away, Julius? Some of the things we talked about earlier.
Yeah, it's funny that you say that, because you're more of a risk taker, because the single stocks, yes. the single stocks that you look at, they can get really hurt. If one of your holdings gets some sort of, I don't know, news thing or get hit with supply, then your portfolio will get a real serious dent, because it's a massive holding in that sector. If you own the ETF, then it's only a percentage of a percentage. Let me indeed grab the screen and show you what I created for that. Where's my spreadsheet? Here's my spreadsheet. Yeah, what I did is, because the example came from the staples sector, and what I wanted to do is make clear for everybody what it actually is, what you're looking at. So what I did is I downloaded all the individual holdings for the XLP sector. This comes from the spdrs.com website, so it's freely available. Everybody can go there. You will get a sheet that looks like this. You got the names, you got the ticker, you got the weight, you got the subsector, and you got the shares held in the ETF. Well, I don't need these sectors and I don't need these shares held, so I cleaned up that sheet and created this. Now, what I added is, if we have a $1 million portfolio, the staples sector is about 7.5% of the S&P 500. So inside the S&P 500, XLP is worth 75,000 US. If we then go down into the breakdown into the individual stocks in that sector, then we'll see that Procter & Gamble is the highest weight at 15.25%. In monetary value, in US dollars, that means almost $11,500. The price of Procter & Gamble is 111. So the number of shares individual shares in Procter & Gamble that you actually own when you buy that ETF is 103 shares. That's what it is. And it goes all the way down to the least weight. This line we can forget. I stop here at COTY. We own 15 shares of COTY, and that's worth $13. So the lowest weight is $13 out of our 1 million, and the highest weight, sorry, that's not right, $194 US out of 1 million versus 11,500. So there's big differences there. Now, when I want to do some money management, I can play at a few levels. If I say I like the staple sector as it is right now, I can come in at the high level and just change this 7.5% in, let's say, 10%, which means that I'm overweighting that sector by almost 30%. 2.5% of 7.5 is almost 30%. So this is a heavy overweight, which means that instead of 75,000, I need to invest 100,000. If I buy the ETF, it means that I just have to buy 10% of my portfolio in that XLP ETF. Don't worry, and it translates in these number of individual shares. I can also say, all right, I like the staple sector, but I'm going to put some extra emphasis on a few individual stocks. So here is a little bit of mixing single stocks with ETF. And what I did here is these last 3 columns is the weight in my portfolio, the number of shares that it translates into, and the value of that piece of my portfolio. So let's say that I really like Coca-Cola. Market weight for Coca-Cola is 10.9%, 10.86. Let's say that I want to make that 12.5%. Then, I messed this up. Sorry. This needs to be equal. Oh my God. This needs to be the portfolio weight. So 15% equals 15% times this money times divided by 100, because it's, so there you go. No, I'm doing this wrong, guys. This is a little bit messed up. Sorry, but I hope you get the idea that this translates into a number of new shares and a new value in my portfolio. And what I can then do is I can calculate the difference between the number of shares that's in the ETF and the number of shares that I need to have for my overweight. And I can then build my portfolio by buying the ETF and add like 20, 30, 40 shares of Coca-Cola or Walgreens or Kraft, etc., etc. And construct my portfolio in that way, keeping a big allocation to the sector through the ETF, and put my little spots, my little extra additional risk in individual stocks without getting hurt if something happens drastically.
All right. Now, this is just obviously consumer staples. So
yes.
So you would go through this process in every sector?
Well, that's the thing you said. You said about a work and active. I think that one of the also, because our audience is primarily retail investors that probably work normal day jobs or whatever. They have a life. They're not in front of a screen all day and not watching the markets all day. So depending on how much time and effort you can afford to spend in the markets, you can play around with that. If you are a weekend investor, or you don't have a lot of time, or you don't want to spend a lot of time, you can create a portfolio just using ETFs. You can go to a little bit of a higher level, put up your portfolio, put all the ETFs there, figure out what the weights are, and then say, okay, I really like staples, utilities, financials, etc. Put money there and calculate how much shares of each sector you need to do, and just let it go. And maybe put 1 or 2 little emphasis, little notches there. Whereas if you're very active, as you are, you can just skip that whole ETF bit and go to individual shares and run your portfolio there. I will always recommend people to keep an eye on what those individual shareholdings on an aggregate level mean towards a sector. Because, I don't know, let's say that you're trading individual stocks, your portfolio maybe has 20 to 30 names in it, roughly. If out of these 30 names, 25 are from the technology sector, your risk is probably a little bit skewed to the technology sector, and you should be aware of that. So even if you trade individual stocks, I'd always recommend keeping an eye on your sector allocations and make sure that they're not too far out of whack. Well, I mean, I don't want to go into your position, but for me, that would be too high risk, because it means that if some news comes out, if something happens to the technology sector, your whole portfolio will get a dent.
All right, I'm going to follow up on that for a second because, and by the way, I'm guilty as charged. I am a risky trader. I've been called that before, but I think it's done with a lot of technical analysis behind it. And I am a momentum trader. For those of you who are new to the show, I'm very much a momentum trader. So I tend to stick with what's working until it's not. But Warren Buffett famously said that diversification is a protection against ignorance. And I know what a lot of us do here and what you've been showing, Julius, it makes sense. But there's also, I mean, when you look at the mutual fund industry, there are estimates that about 80% of mutual funds underperform the S&P 500. So either they're not doing the market analysis, that you talked about and constructing a portfolio properly, or maybe their expenses are too high. But, that's the choice that most people have to make, either to construct their own portfolio or to go with others who are putting together portfolios that are not able to keep up with the benchmark. So I like the idea of taking the best stocks within the sectors. And I would say you don't even need to be limited by the ones that are included in the ETF. So in the XLP, Joyce, you just listed all these individual stocks. There's obviously a lot of other consumer staple stocks that are not in that particular ETF and provide some opportunities. But I wanted to see if Erin would chime in. Just any general comments you have, Erin, about diversification, about being in ETFs versus individual stocks and so forth. I mean, do you have any thoughts to add there?
Well, I mean, I obviously am a little bit lower risk than you, Tom. Typically, my time horizon is such. So I get your point about, having the underperformance a lot of times from these sector funds. But, at the same time, your risk level is not the same. So you may not get that, big payoff at the end, but you're taking on more risk. And I think, Julius, you mentioned it in your article, and we were just talking about it. If you're not going to be glued to your computer screen, if you're not able to really watch your short-term investments or your allocation that way, I mean, I do invest in some of the ETFs. I do like to go into the equal weights myself, just because of the fact that it is weighted the way it is, and I get pretty much equal exposure across all of the components. But really, that's my thing is, I think your time horizon, what I also suggest to people that I do is, have different accounts with different time horizons in mind. Your buy and hold portfolio, your, swing trading portfolio, your really short-term portfolio. But those are the things you have to consider. I mean, you may get better performance, but you have to be able to watch. I mean, that's ultimately it, right?
Yeah, it takes time.
Yeah, I'm gonna share a chart with everybody, and then Julius, you can feel free to take it back. But this is a chart of a different sector. We were talking about consumer staples, but this is the energy group. And this is energy relative to the S&P 500. And there are a number of factors that go into this, but of course, the rising dollar that we've seen the last 8 years has certainly played a part in the fact that energy has been underperforming the S&P 500 for a while. Now, in constructing a portfolio, and I am not a portfolio manager, never been one, never had to manage money for a wide number of people and so forth. So there's definitely an element of risk that you have to take into account when you're managing money for others that you don't have to take into account necessarily when you manage your own. Because, at the end of the day, it's you've got what however you invested and however things turned out. But when I look at an area like this, energy, I don't want to invest in an area like this. And I know, you go through periods. We could point back to 2016 where we had outperformance in energy. You can look at this pop in 2018 where we had a move to the upside. This is a relative chart. Again, this is not an absolute chart. So this is just simply telling us how energy is performing relative to the S&P 500. If I take out the S&P and I just simply pull up an energy chart, you'll see that we actually, during this period, we had some pretty good periods moving higher, but we didn't do it, or we didn't outperform the S&P 500. So I think when you construct a portfolio, and I know you wrote about this in your article, Julius, you have to decide what your goals are.
Of course.
And if your goal is to outperform the S&P 500, looking at that chart that I just showed you on a relative basis, the money that you invest into the energy group is going to be an area, it's going to be hard to outperform if you simply stick with the percentages of energy in the S&P 500. So,
but hang on a second. You can be pretty aggressive with ETFs. I mean, that's the analysis part. So if the analysis part, and I 100% agree with you here that I don't like energy either. So in a portfolio only using ETFs, I can perfectly see 0 holdings in energy.
Okay.
So out of these 11, you don't have to. It's like we're not like professional PMs that can deviate only marginal basis points from the market weight. We can actually make a dent. So what's energy in the S&P 500? It's not a big one, but it's like maybe also 8 or 10%, probably like that. Yeah. Chop that off. Just 0 holdings in energy, and you have 10% of your money that you can spread out over a couple of sectors that you do like. So I can see for a private investor a portfolio with its own goal of beating the S&P 500 with maybe 4 or 5 holdings. So you just pick 5 sectors in the S&P that you really like, and you stick your money in there, and you can do that as Erin said, equal weight. So you can put 20% of your money in each of these ETFs, or you can do that pro rata for these 5 sectors. What's left? It's a simple calculation. I mean, you can put that all in spreadsheets and make it work for you. What I was trying to explain is that when you buy an ETF, you actually buy a whole basket of stocks, and you actually own, as I said, 7 shares of COTY or 110 shares of Procter & Gamble. If we decide that we don't like staples, we own 0, because at the top line, we just have 0 allocation to staples, which means that it trickles down. We have 0 allocation to these individual stocks. So, I mean, that's the point that I'm trying to make, that it's a versatile process. You got a lot of options. You got a ton of options, actually. And I feel that a lot of people are not aware of the options that are available to them to actually play around with these numbers, mitigate their risks that they might be running that they're not aware of.
Mm-hmm. I've got the cap weights here on the screen.
Right. So energy, 5%.
Yeah, 5%.
Yeah.
Of course, it's the only one on sell signals too.
Yeah. So if we look at this, we don't like energy, so we chop off 5% there. We like staples, so we put staples. We put 5% in staples, which means that staples goes from 7.5 to 12.5. There you are. So then, without a lot of work, but with a little bit of analysis, we now have a portfolio which is heavily underweight energy, 0, and overweight staples, and the rest is market weight. So there you go. There you have a very well spread, balanced, diversified portfolio in the S&P 500 with a bet built in that we like staples and we don't like energy.
Mm-hmm.
And you can actually do that. So I actually got my my spreadsheet back up and running. I thank God for Control Z, where you can actually go back.
Go ahead and share it.
Yeah, so I'm gonna quickly share it with you. What I have here is the same 1 million, and what I just did while we were talking is upped the percentages for the top 3 shares to 15%. So 15. So I'm overweight Coca-Cola and PepsiCo. And what the sheet does, it calculates how many extra shares you need to buy of Coca-Cola and PepsiCo. So 75,000 is 7.5%. If I put those two at 15%, my total weight goes to 8.14 because I'm now overweight more than 100%, which means that I buy XLP and I need to buy 60 extra shares of Coca-Cola and 26 shares of PepsiCo, and then I've got the whole sector with emphasis on Coca-Cola and PepsiCo. By the way, people who like this sheet, I just literally put this together in 15 minutes. I'm happy to share it, but I'm sure you guys can actually put it together yourselves if you want to. If you need it from me, just send me a message and I'll be happy to share it.
All right. Well, we're going to go ahead and wrap up, but I do want to finish by, again, just reminding everybody, this came from Julius's blog, RRG Charts, here at StockCharts. If you liked what you were hearing, I know Julius does a number of articles and takes a look at things from a relative perspective. That's the whole RRG deal, the relative rotation graphs. And at the bottom of all of our articles, all of our blogs, you have this opportunity to subscribe. So you just type in your email address and subscribe. And then anytime that Julius publishes an article, it will be sent to you. And I just want to wrap this up with the bottom of the article. And, you know, we talked about market analysis, and then we also talked about construction. But I think this RRG that you showed is a little bit of an indication of how you can analyze very quickly some of the stocks in the staples area that, you know, were not performing very well. And I think this RRG chart here showed it really well. So I just wanted to, again, let everybody know how they can subscribe to your blog, Julius. I think this article was absolutely spectacular. I think that, you know, the discussion's been a really good one. I think everyone's got a little different approach to the market in terms of the risk they're willing to take, their goals in trying, you know, what your goals are in the market. But if nothing else, I think that this at least has everybody thinking about.
That was probably the intention. Just really quickly, because you're touching upon one of my favorite subjects, and we didn't have enough time for that. But one of my pitches when I talk to people is that it's very often more important to know where not to invest than to focus where to invest. Because if you look back, if you're able to avoid the bleeders, your return usually always goes up. So one of the options that maybe not a lot of people are aware of is that you can actually buy an ETF and then strip out the stocks that you don't like. So for this one, you could buy the XLP ETF, and if you're in your account able to short, you can look in the spreadsheet, see how many shares or how many percent you need to short out of these stocks to avoid having them, bring that level to zero, or you can do it via options. You just need to calculate the delta of the options, and you can buy puts or sell calls to get a negative delta on these names. If you buy the XLP with a short position in these names, you basically own the sector without the stocks that you don't like.
Excellent point. That's a very, very good point. So I hope everybody's enjoyed this. We are starting to do these panel discussions a little bit more often. Of course, just a couple of weeks ago, we had Dave Keller on, and he and Erin discussed and contrasted the differences between Bitcoin and gold. And now today, really taking a look at market analysis and kind of separating it from portfolio construction. We have a poll up. We were asking you all to give us your thoughts on whether or not you separate the two. And the majority say no, that they do not separate the two. That they Sorry, Julius. Maybe when you come back next time and we have this discussion again, the numbers will be flipped.
Yeah, hopefully.
Yes.
All right. It was a fun, very fun segment, though, and I really appreciate you joining us, Julius.
No problem.
All right. We're going to move on to the I got RRG on my mind. We're going to move on to the 10 and 10. And Erin, I don't know, you have an RRG chart?
No RRG, but I am
probably not.
I'm quickly putting them in my spreadsheet, so I should have all of those. But go ahead and vote for your favorite in the chat room, because that will be the second one. But we're going to start off with PLNT.
All right, PLNT, which is Planet Fitness. Probably a place I should visit more often.
Grab that screen, Tom.
Yeah. Okay. Planet Fitness. Here you can see it now. I have it actually up on my relative strength chart, which I like to use. And first thing I noticed, the group has not been doing very well, but Planet Fitness has been a really nice performer in this group. So I like the stock. I think we just had a double top win in a couple of days ago, so we might see a little bit of consolidation. But overall, I think this looks pretty good. I'm just going to annotate a couple levels that I would watch closely. I think to the downside, after we made this new high, we pulled back, I think established a pretty good support area, just below $75. I would suspect that we will hold that. If you wanted to give it a little bit more room, we sold off, well, we gapped down on very heavy volume in early May, went down lower intraday, but since have come back up and we've closed above this 70.5 area. So that would be my kind of like final line in the sand, I think. And one thing to keep in mind too is when you've got a stock like Planet Fitness that's part of a group that is underperforming overall, I think that can be a problem if you begin to lose support levels, because you've already got dwindling money coming into the group. And then if the stock breaks down, you're going to have even less money going into that individual stock. So you definitely want to keep your stops in play. And those are the two levels I'd watch here.
Okay. The most popular in the chat room is Boeing, BA.
Okay, Boeing, I did like the move yesterday, getting back up above that 360 level. I think that was a change in character on this chart. First of all, I think the overall long-term chart on Boeing is very strong. So short-term, when we gapped down back in March, all the difficulties, all the issues surrounding the 737 MAX planes, I think that was a problem for Boeing in the near term. And I still think we're probably going to see some resistance above at 400 if we get there. But let me just show you here what I would do with Boeing. I think to the upside, 400 is going to be an area that Boeing's going to have some difficulty probably for a while. Maybe off of this move up, what we're going to see is a little bit of an inverse head and shoulder. Here's the low, the reaction high, another low. Now maybe we get back up close to this 400 level and then maybe one more pullback. But I think on the pullback, what I would be watching for is 360. If you look across here, 360 intersects a number of times on this chart. This is a key pivot area on the chart. March and April, it marked major lows. We broke down below it with increasing volume in May. Look at the failures coming back up here. And now volume picked up earlier this week. And we had the breakout above 360. So I think 360 to 400 is the trading range right now on Boeing. I like the stock. Long term, I really like it. Short term, I like it in this trading range. I like it on the buy side. Closer it is to 360.
All right, let's see. Next one up is going to be PAAS, and that is Pan American Silver.
Yeah, a number of these stocks are really, I think, starting to look much better. Obviously, some of the precious metals moving higher. A lot of the commodity prices, with anytime you get a dollar that's under pressure or a Fed that is becoming more dovish, that can lead to a weakening dollar, which in turn helps commodities. So I think that this is a stock that not only is looking like it's changing its move from a downtrend to an uptrend, but also look at the breakout in its industry group. This has just been one of the weakest performers within the space, but you can't argue with the space. So what I would be thinking about here is it does look like it's trending higher now, and we do see the 20-day coming up from underneath, looking for that golden cross above the 50. I think I would watch that 20-day moving average to the downside, because keep in mind, this has been one of the worst performers in the space. So if we start to lose key technical support levels when the overall group is flying to the upside, I think that can be a problem. So that's an area, the 20-day is an area I certainly would be monitoring on any pullbacks.
All right, I absolutely love this symbol. It is for the Invesco Dynamic Food and Beverage ETF, PBJ.
Oh, PBJ.
Yes, PB and J, you know.
Yep. Don't need the relative chart here. Yeah, I'm a fan of PBJ, not necessarily the ETF, but the sandwich.
Yeah.
Way too much information. I actually like the pattern here. A nice uptrend. I think we pulled back, came back up, couldn't get through, put in a lower low, almost like a little bit of an inverse head here. Came back up, almost even here. Maybe a little bit of an upsloping neckline. Come back down, nice hammer off the moving averages. I think we're going to get a breakout here, and a confirmation would be clearing that recent high there. So I think a move back up above, say, about 34.40 would be a very bullish development here with PBJ.
All righty. Next one up is going to be the biotech ETF, XBI.
All right. I think the biotechs definitely are looking much, much better. I talked about this recently. Even though we got a little bit of a black candle here, meaning that we're up for the day, but we're down below the open. So we've had a little bit of selling since the open today. I think this uptrend is for real here. And so I suspect we're going to go up on the XBI and test that prior high around $94. The other thing that I would mention is, and I've mentioned this quite a bit, the best time of the year for biotechs, without question, is the month of July, June, July. So we're starting to see some technical strength as we're getting closer to the best historical month of the year for biotech. So I would be a buyer. I do own some names in the space now.
All right, let's see. Next up is going to be Nike, NKE.
This is very interesting because I do like this breakout here on Nike on the one hand, but then, of course, there's always the other hand, which in this case is gap resistance. So right here, notice back on May 6th, we gapped down from this level, and you can see the bigger volume, and notice the failure back in May. We were coming up, looked pretty good, couldn't get through, went to a lower low. Now we're coming back up. Is this just going to be like a neckline with a drop? But the real interesting part, I'll go ahead and save this, but I do want to show you on a relative chart what I was referring to. But the footwear group as a whole is an area. I look at industries, and I really try to monitor, at least on a weekly basis, the different industry groups relative to the S&P 500. And when you look at footwear, it doesn't really show as much here, but I think this is going to be a critical area for footwear. And the way I like to look at it, and I'll just try to do this pretty quickly, is pulling up the industry group versus the S&P 500. I like to do it using line charts. I want to do a weekly chart, and I want to go back at least a few years. Let's just go back 3 years and then pull this up. Notice that we've been in a nice uptrend in this group relative to the S&P 500 for about 20 months, maybe 19 months. But the last 4 months, we've been downtrending. We are sitting right on this 50-day moving average that we have been above for a while. Look at the relative PPO right on the center line. I'm waiting to see which way we move here on footwear. My guess is it moves to the upside, but I'm not quite sure at this point. So if this starts to break to the upside, I believe Nike becomes a much bigger buy at that point.
All right. What do you think of Ericsson Telephone, ERIC? It's at the top of a trading range. I've got a buy signal on the PMO.
Yeah, I actually like the stock because it is part of the telecommunications group, which has been very strong over the last year. The stock was showing a lot of strength earlier in 2019, hit a 52-week relative high versus its peers, backed off, but I think it's starting to turn back to the upside, and volume trends seem pretty strong to me. So I agree with you, Erin. I think this is one that, maybe we should keep on a watch list. And in particular, I think this 10.05 area is really big. A breakout above that would be, in my opinion, very bullish, especially if accompanied with some nice volume.
All right. In the comm services area, entertainment, Discovery, DISCA. It's quite a cup there. Where's the handle?
All right, let's see. Yeah, that's a long cup. That goes way. Are you referring to since May? This
yes,
move?
yes.
Okay. Yeah, it hasn't quite gotten back up there, and the depth of the cup versus the uptrend is a little deep for me. But yeah, the other side of it around 31.5, 32, I definitely, we've seen rallies fail there on a couple of occasions. So I definitely have to respect that. And what I'm referring to is not just the high here, but look over here. We moved up. Look at the selling that took place from that level back at the end of November, early December. Failed again at the end of April, early May, and now we're making another run. Good news is we're holding the 20-day moving average on pullbacks. The bad news, we got a lot of overhead resistance. Great group, not such a great stock within the group. So a lot of mixed signals. I'd have to see this breakout before I have any interest here.
All right. This chart is shaping up well, but I don't like the industry. It's oil equipment and services. Helix Energy, HLX. It's a nice breakout, and my PMO just went positive, but I just can't, I just can't go there.
Yeah, I'm, mixed. Number one, and we talked about this earlier, how I wouldn't touch energy because that long-term downtrend. One thing I did fail to mention is that sometimes even in a bad group, you can still have a really good stock. And so this stock has been a good performer relative to its group. The thing that would simply keep me out of it is that I just don't like the group. So I think there are a couple of levels to watch here. If the group were to strengthen and started to show some significant relative strength, then I'd be interested. But notice after gapping up here above all of this resistance, we pulled back, we held support, then we broke down on big volume, failed to get through this 870 area, failed again in April to get through, and now we're making this run back up toward this level. I think as you get closer to 870, I think this stock is a sell until it can prove that it can make this breakout. If it does make the breakout, you can at least be somewhat comfortable in that it's one of the better stocks within its energy industry group.
That's for sure. Our only financial request was Every Holdings, which is EVRI. I'm not a fan.
I love this stock. I absolutely love this stock. Well, again, I'm a momentum trader, and I know maybe on the short term, I think probably what you're seeing is your PMO way above zero, kind of rolling over would be my guess.
Yeah, it's not overbought, but I don't know.
Well, I like to go with the groups that are leading. Financial administration has been one of the best areas of the market. So money is pouring into those stocks. And if you look, this is a smaller company, but it has actually performed very, very well versus the financial administration. And the fact that it's consolidating, I don't have any problem because it's consolidating in an uptrend, hasn't lost any major support levels. We might see it continue to consolidate, but I think you're going to see this stock at worst, well, maybe that wouldn't be good if it goes from 1150 down to 1070. But I think at worst, this is the trading range, and I fully expect the next move is going to be, next big move would be a breakout above that. So I like the relative strength here, and I do like the stock. I've got an aggressive portfolio that I've been keeping track of, and this one is actually in it.
Yep. I think in the intermediate term, as far as an investment, definitely get a little bit of a pullback, and then you can count on the rest to happen. But all right, here are the symbols that Tom just annotated. I will have those up in the MarketWatchers live chart list at the end of the show. Just go to the articles tab, click on the MarketWatchers live blog, and the link to that list is right there at the top. We'll be right back with the final market update.
Hey there, today we're going to talk about Fibonacci retracements. Fibonacci relationship is a mathematical phenomenon designed by this gentleman Leonardo da Pisa in the 1600s, if I remember my financial history correctly. Basically came up with the sequence of numbers where you add two numbers to get the third number. 1 plus 1 is 2, 1 plus 2 is 3, 2 and 3 are 5, and it goes through this Fibonacci sequence where you keep adding them. As you go along the sequence, what you find is that every number gets closer and closer to 0.618 of the next number, and every number is also 1.618 times the previous number. So 61.8% or 0.618 is called the golden ratio, the golden point, the divine proportion, all these other names for it. Now, how do we use it in terms of technical analysis or chart analysis? We're looking at a chart here of Alphabet. What I'm basically doing is I'm taking a high from July of 2018, then I'm taking a low from the end of December of 2018. And I've said the highest point is in July, the lowest point is in December, and now I've sort of set this range from 0% all the way up to 100%. Now the Fibonacci relationships are 0.618, retracing that way up to the 100% point, and it's also 38.2% or 0.382, and 61.8 and 38.2 equal 100%. So they're complementary. So what happens is when you're looking at a chart, the 38.2% level and the 61.8% level, also the 50% level halfway through, often become significant support and resistance levels. And you use them along with traditional support and resistance levels you might be aware of. So looking at the specific example, as you come out of the December lows, you would first expect resistance based purely on the Fibonacci levels around 1100, which would be 38.2% of the way back up, retracing that sell-off that we had July to December. And as you can see, we traded up to that level, we pulled back a little bit, so that's sort of expected. We would then expect resistance once we break through there at the 50% level, finally at the 61.8% level. Now, if you look at the chart of Alphabet now, you'll see that it bounced off the 61.8% level, pulled back to the 50% level, now has broken above it. So those levels, the 61.8 and 38.2% levels, oftentimes will give you sort of a line in the sand, a level at which you might want to revisit a position, evaluate whether or not you want to continue to hold it, or at the very least expect a pullback or a sell-off or a rally around those key levels, because they tend to be logical places where a market will tend to reverse. It's very easy to apply these on stock charts. All you do is go down to the annotate button, and in the palette that pops up, you have a Fibonacci option that you can put on top of there. It's something that's very easy to apply to charts and just gives you a visual cue to identify some key support and resistance areas for charts that you're looking at.
That was David Keller on Fibonacci retracements, but we are back right now with the final market update. Let's see what has been going on in the markets. I just updated this candle glance. As you can see, markets are pretty happy right now on the positive side, but notice that we have hit intraday highs and we are starting to pull back toward yesterday's closing prices. Notice with the NASDAQ, really big move back down. So we'll have to see if we can remain in positive territory. If the S&P 400 and 600 are any indication, we should be able to bounce off of yesterday's close and continue back higher, even after this pullback. The Canadian markets are looking about the same, with a big gap up earlier on the open and pulling back, taking about half of those gains back right now. Treasury yields are lower, but making a little bit of a comeback here. Currently under 2% at 1.998%. The VIX is beginning to rise again. It is at 15.18. UUP is down over 0.5%. GLD, as we've been talking about, gold is making a huge move, big gap up. Currently, GLD is up 2.42%. USO is also having an excellent day, up over 4%, currently reading at $11.80. And TLT made a nice move to the upside for the morning, but is pulling back now toward yesterday's close. Quick look at what sectors are doing the best today. And you can see energy, which we have been really giving some not any love earlier in the show, but it is having a great day, up over 2% right now. Financial sector, the only one in the negative, down a little over 0.25%.
All right, I wanted to just go through, I had a chart in my Trading Places blog earlier today on travel and tourism. When you look back at this one-year chart, I think it's pretty obvious that there have been a number of failures along this trend line. And anytime you have a trend line, in my opinion, it's much more significant when you have multiple tests and failures along that trend line, or successful tests in an uptrend. But here we have been trading lower. I also mentioned that on a relative basis, looking at this industry group relative to the S&P 500, we've been in this downtrend for a while as well. So there's really two things I think we need to see here. Number one, we want to get that get that absolute breakout of that downtrend line, but then also we want to begin to see relative strength. We don't want the group just simply to be going up with the S&P 500. We want to see it outperforming the S&P 500. It's been doing that since the beginning of June, but I'd like to see it take out that reaction high. Keep in mind that many of these charts in your blog, these blog articles, if you click on them, you can get the live version. So this is updating with today's action. You can see that on an absolute basis, we are trying to get through this this downtrend line, but on a relative basis, today we're really not performing that well. So again, this is something that I look at. I see the technical, excuse me, the absolute breakout above this trend line, but I don't see the relative strength necessarily. So that's something to think about. All right, we are going to move into our final segment of the day, and Julius has been very patiently waiting around for us, which we certainly appreciate, Julius. But we're going to get into a segment that we feature from time to time. Are you buying this? And essentially what this, we're going to make a statement, and then each of us get an opportunity to kind of state our case as to whether or not we're buying it. So yesterday we had the Fed come out. They certainly have turned a little bit more dovish, and that is having the impact of sending Treasury yields lower, which in turn has the impact of weakening the dollar, which in turn has the impact of sending gold higher. And we are seeing a huge move today in gold, moving to a multi-year high. So the statement here is that with the Fed turning more dovish and with this breakout in gold, gold outperforms the S&P 500 in the second half of 2019. So, Julius, you are our featured guest. I think you should go first and give us your thoughts. Do you think that gold outperforms the S&P 500?
Well, the short answer is yes, but I'll try to explain why I think that. I brought up gold here against the S&P 500, and as you can see, it is rotating just out of the lagging quadrant, starting to move into improving and heading over to the right, getting into what I call a positive RRG heading, which is between 0 and 90 degrees. I think the question was the next few months. So it's a little bit of a longer term view. This is a weekly RRG chart. And I can see this rotation continuing. And the reason why I can see that is found in the longer term picture, because on the left hand side, I now have the monthly chart of gold, which if you just forget about the lower two panes, which is relative strength in the RRG lines, looks like a massive base forming to me. And I just plotted the Fibonacci lines there, not necessarily because I'm looking at Fibonacci retracements where Dave was just talking about, but one of the Fibonacci retracements is the 50% level. And when you do that, this area here, where that bottom came in, is about 50% of the rally that started back in 1999, 2000, all the way to that high. So we've worked our way off, corrected 50% of that move that lines up with the high of 2008. And we're now seeing the last few years, every time the high coming in at a higher level, which to me means that buyers are prepared to pay higher prices to get in. We have resistance, we have supply coming in around 1400. But the question is, with these buyers coming in at higher prices, how much more supply is left to keep gold under 1400? So when that pops, that 1400 level, then I think we're in for a real treat. If I look at relative strength on a monthly basis, that's starting to improve. But if we do it on a weekly basis, which is this chart, and I switch to GLD because then I have the real-time price for today, which shows the jump, you see that on a relative basis, this high is higher than the previous, this low is higher than the previous low, which is a first positive sign, and that we are moving. And this corresponds with the position on the RRG that you see here on the right-hand side, with RS ratio still below, but rolling up, and RS momentum ready to go into the improving quadrant. I think that we're seeing the first signs of a breakout, and I believe that that could lead to a further improvement against the S&P 500. So my call is for gold to outperform the S&P 500 in the months to come, assuming that this rotation will continue.
All right. Very good conclusion. I like your argument. Erin, what do you think?
All right. Well, my short answer is also yes. Let me see if I can pull up my charts here for you to see. The one chart I'm going to show you is my weekly chart when I can get this. So as we continue to talk, and as I talked about in my blog yesterday, the one thing you need to consider is that everything is really lining up for gold to do well right now. And when I look at the weekly chart, and you were talking about it on the monthly chart, and I could show that, but you showed it so beautifully, Julius. And I love the RRG look, because that just really, in my mind, explains exactly. You can see it curling, and it just everything just is lined up so nicely. One of the things I wanted to point out is that we've had these really high discounts on the physical gold trust. We track that, and typically, when you get these really high readings, you're going to see a move to the upside. That is very bearish when you see discounts. That means that people are in there, they are feeling bearish about gold. And of course, if you feel very bearish and it's sentiment, then you should expect a move to the upside. Everything is lined up. I've got a PMO buy signal on the weekly chart. It is not at all overbought, so it has plenty of room to move up higher. I am looking at the S&P. You don't necessarily have to expect the S&P to really fail and have a correction or something for gold to outperform. And I think in this instance, that's going to be the same. I think we're still going to see some good action out of the S&P, but I just think gold is going to move faster.
All right. Last time we did this, you two went against me.
Mm-hmm.
And I don't remember what the topic was, so I don't know who was right and who was wrong. I was probably wrong.
We were right.
You don't even know what it was. Come on, Julius. But I am going to disagree with both of you. I don't trust gold, and I will show you why. So first, when you look back at gold, now I'm using the GLD, and you compare it to the S&P. This isn't about whether gold goes higher. It's about whether it outperforms the S&P 500. I think gold can go higher. I talked about it recently. I think the dollar could be under pressure for a little while. The Fed is starting to turn more dovish. I think that's going to weaken the dollar, and I think that is going to help gold. The problem I have, and before I even get into this chart, I'm going to bring up the 10-year Treasury yield versus the S&P, versus the German 10-year Treasury yield. And we still, even though we've been in this downtrend here, we do continue to remain in generally in an uptrend. And that means that the dollar remains in an uptrend. Now, could the dollar fall back to this trend line? Absolutely. And that's why I think that gold could have some strength. But will it have relative strength? I want you to look back here, 2017, when the dollar fell from 102 and change, the dollar index, back to 88. That was about a 14% decline in a little bit over a year. Now, remember, that was throughout the entire 2017 year. Look at what gold did relative to the S&P 500. It actually went down and established a new relative low. The problem I have with gold and with this statement is I think we're in a major bull market for equities. And so do I think gold goes higher from here in the second half? I do. I think gold is probably going to go up. I think a lot of asset classes are going to go up. I think the S&P is going to go up faster. And when I look back at this chart, I mean, I don't know if, go back to the movie Jerry Maguire, Show Me the Money. But when I'm looking at this and I see the relative weakness in gold, which now dates back 8 years, and we have never had 1 6-month period of outperformance anywhere along this, it makes it very difficult for me to make the argument that gold is going to outperform the S&P 500. So again, if you just look at the chart of gold, and, I don't disagree with your arguments that gold goes higher. I think that right now it is looking pretty bullish. We broke that downtrend. You can see that gold was trading on this monthly chart below its 20-period moving average for quite a while. We've been consolidating. I do think with a weakening dollar, we could make this breakout above 1,400. But I don't think we're going to go screaming back up to 1,900. If it does, then it probably will outperform the S&P 500. But I think it's going to be an up and down. The Fed's going to be saying their stuff. The Fed is not going to be dovish forever. I think that they're, maybe appealing to the market a little bit here in the short term. But I do think the Fed will eventually turn back more hawkish I think that will continue to keep the dollar in a longer term uptrend. And unfortunately, even if we break out the near term on gold, I still think that this long term relative weakness persists. So I don't, I know that was a little bit of a long winded explanation, but I like gold. I think gold does go higher. I think energy goes higher. I think materials go higher, but I don't think they outperform the S&P 500. I think the S&P 500, I think you stick with what's been leading the market in this bull market. Gold is not one of those areas. So yes, absolute value, I think gold goes higher in the second half, but from a relative perspective, I do not believe it outperforms the S&P.
So you don't put too much stock in those rising bottoms then on that chart?
This chart that I have up,
Mm-hmm.
Are you talking about right here?
Relative. Uh-huh.
Well, I mean, we've had that before, though. I mean, the problem is it just doesn't sustain. So I'm looking at this as negative. What I would really like to see is every time we get a big pop in this relative strength, we never can go back up and clear it again. So that big pop we had in the fourth quarter, I would like to see this get back up above that. If we did that, I think the argument would be a lot clearer on gold versus the S&P.
All right.
So,
I buy that.
I just tried to run a couple of numbers because one of my arguments was that I assume that we're going to see that breakout above 1400, and if I just do a basic rule where you flip the height of the pattern to the top side, we would have like $400 of upside potential. That would bring gold to 1800, which coincides with that major top level over there. 1400 over 1400 is 28%. If the S&P needs to outperform gold, it needs to go to 3760, which I think is quite far-fetched from current levels. If we do $200 over 1400, the S&P needs to go to 3350, which still is, I don't know, in my mind it sounds like a very high number. That's one of the, trying to give some arguments why I think that gold is going to be the relative outperformer here. But we'll see. 6 months from now, make a note.
Yeah, I would just argue, I mean, I don't disagree with your measurement and all that, but it can happen over time. This whole pattern has been over a very, very long period of time. So my argument there would be, are you talking about going to 1800 by December 31st of this year? If we are, then I completely agree with you. I think that outperforms the S&P 500. But if this is something that just kind of stair steps up and eventually gets back to that 1800 level, we could be talking about gold maybe up 5% in the second half of the year, and the S&P could be up 10%. So I disagree with your measurement, but maybe the timing that it takes to get there, I would be shocked if we're at 1800 by the end of this year on gold.
Yeah, and by the way, if the S&P breaks 2950, we're in for a treat as well. That goes, there's a lot of potential there too.
Yes. Well, I will say this has been a lot of fun, Julius.
For sure.
For participating and having some fun with us today on this panel discussion. I thought your article, by the way, was spot on. I think a lot of folks, if you haven't read that whole article, really should go back and take a look at it. I thought you raised some excellent points, not just in the article, but today on the show here, Market Watchers Live. So thank you so much, not only for your contributions and your blogs, but also all of your appearances that you make here with us on Market Watchers Live. We certainly appreciate it.
Indeed.
No problem. Thank you.
Well, it was great to be able to see you this time as well.
Yes, I made my debut, so my radio face is now on the internet.
I love your hat.
Thank you, the master. Next time it'll be stock charts. I do want to just quickly let everybody know the Dow up 174 points. We are starting to rally again. Okay, I want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody, and hopefully we'll see you back here tomorrow. Happy trading.